Es momento en Negocios Televisión de analizar las estrategias de mercado, de ver desde el prisma de la industria de gestión de activos cómo están reposicionando sus carteras ante las tensiones geopolíticas, ante la situación arancelaria y también pendientes del ciclo de política monetaria. Saludamos a nuestro siguiente invitado, CHARUDATA SHENDE, especialista de producto en renta fija en Candriam. CHARUDATA, hi, good afternoon.
Good afternoon. Thank you for having me.
Well, first of all, the ECB has kicked off its rate cutting cycle while the Federal Reserve remains cautious. How does Candriam interpret this divergence in monetary policy, and what are the implications for fixed income allocation?
Yes, thank you for the question. The divergence in monetary policy between the ECB and the Fed has existed for a few months now, and we've seen evidence of it, and we find that to a great extent, it is understandable. The divergence is understandable. The ECB has firmly embarked on its rate cutting cycle. They have lowered rates for the past year, and this has been in response to easing inflation pressures and weakening economic momentum. In contrast, the divergence of the Fed is that the Fed has shown a lot of restraint and have held rates steady despite a lot of political pressure because they're trying to navigate a more uncertain inflation backdrop, a resilient macroeconomic situation, and labor market. So in the context of this divergence, the implication for fixed income allocation at Candriam has been to favor euro duration, euro credit versus US credit. Now, what is also important perhaps is looking ahead, do we expect this divergence to continue? To a certain extent is the answer. The ECB appears to be nearing the end of its easing cycle. Markets are currently pricing only one more rate cut before year end. And the ECB themselves have come out and communicated regarding this end of the easing cycle. The Fed, on the other hand, seems to be ready to initiate its rate cutting cycle because there are signs that inflation is gradually retreating and labor markets are showing some signs of fatigue. And so that means that the divergence between the two is likely to continue. The main risk for us in this scenario are the tariffs that has been flagged by Chairman Powell as being a potentially significant factor that could really shape the inflation outlook, even if it's a one-off. And over the summer, we're likely to have, and the Fed is likely to have greater clarity on the impact of this tariff. On top of that, if you have the escalating tensions in the Middle East, which have lifted oil prices, then risk of inflation could flare up, and that could end up derailing the rate cutting cycle of the Fed. And even the ECB has acknowledged that there's a risk of stagflation within the geopolitical tensions that we see, and that could result in a pause in their rate cuts as well. So overall, we still continue to maintain a constructive stance on euro duration, on euro credit, more than on US duration. But recently, we have initiated a tactical tilt towards US rates. All in all, in US, we're still a little bit cautious in light of the inflationary pressures. And so we want to make sure that we're careful in that stance. Tactically positive, but much more positive on the Eurozone duration.
How does Candriam assess current credit market fundamentals, particularly across investment grade and high yield segments in an environment of elevated interest rates?
Yes, rates are elevated, no doubt. For us, in terms of credit market fundamentals, if we look at investment grade, then Eurozone investment grade remains fairly stable for now. Corporate fundamentals are well oriented. There is a balance of rising stars that is higher than fallen angels. First quarter earnings were broadly strong. They were supported by robust balance sheets, very manageable leverage. But the forward guidance that was accompanying these earnings was quite vague. And companies are increasingly aware that uncertainties lie ahead And the biggest uncertainty, of course, for Eurozone companies is the prospect of a more permanently hawkish US trade policy. So we think that trade tensions are once again rising. Of course, Europe is now negotiating with the US, but you've seen, import tariffs on steel and aluminium, more sectoral tariffs to be expected. And on top of that, we don't feel that these are necessarily just standalone measures. They appear to somewhat be part of a much more broader fiscal rebalancing strategy. And so if Trump needs the big, beautiful bill to be passed, then on the other side, perhaps they need these kind of inflows that come from tariffs. And as a result, this could weigh on European corporates, these tariffs, particularly on exporters and multinationals. So on investment grade, overall, it's stable. The outlook is stable. The current situation appears to be stable, but in terms of the outlook, we could see some gyrations coming in. On high yield, it's a slightly less positive picture. And the reason is, of course, that fundamentals are weakening. In European high yield, we're now starting to see defaults. In May, there were 3 defaults in the European high yield market after a period of relative quiet. Even in the US, you see that the picture is deteriorating with US high yield default rates climbing, and that reflects the challenges posed by higher borrowing costs, tighter financial conditions, and generally weaker economic momentum. So from that perspective, we do have a preference for Euro high yield versus US high yield, but even on Euro high yield from a fundamental perspective, we think that the situation is not that strong. And the last point I would add here is that, fundamentals could also lead to, the threat of hurting technicals. So if there is a downgrade or a big fallen angel from investment grade to high yield or a big default, then the fragile balance of these inflows could really be disrupted, and that could really trigger a chain reaction of outflows and spread widening. So from that perspective, credit spreads are tight, and there is very little buffer against fundamental surprises.
And CHARUDATA, credit spreads have tightened significantly in recent months. Do you still see value in current valuation, or are there signs of complacency emerging in the market?
Yes, that's an interesting question, and it's a good transition, because you're right. Credit spreads have tightened after Liberation Day. They really came down very strong, and there does seem to be appearing some sort of a disconnect between macroeconomic risk and investor behavior and flows, because we see the risks. There's downside risks to growth. That there is increasingly softer economic data, geopolitical tensions, tariff threats, and all this, against all this backdrop, you still see spreads at relatively tight levels. So you're right, there is some complacency in the market. On the other hand, despite all this, clearly we do understand that everything is not explained by complacency. Everything is not exuberance. We have to understand that, spreads by definition represent a premium over risk-free sovereign yields. But the risk, there is more concern on these sovereign yields, because the sovereign fiscal sustainability with higher deficits, higher debt, there are legitimate concerns about the credit worthiness of these sovereigns. So the question really that the market seems to be asking is, with a similarly rated corporate, do you want to own the corporate or do you want to own the sovereign? And the question is not that simple. We almost have an impression that the inversion of the traditional risk hierarchy is one of the reasons why spreads are so tight, is because investors have less confidence in the sovereigns than in the past. So valuations are rich, no doubt, and investor behavior seems to be downplaying the growing risks. we do believe that a portion of this compression reflects a revaluation of relative credit risk more than before.
Finally, CHARUDATA, which sectors or types of issuers are showing the most resilience or attractiveness in Candriam's credit portfolios given today's macroeconomic backdrop?
So that's a timely question because it's true that it highlights the growing dispersion in credit markets. Now, so far, dispersion is not being very present, but we feel that there's a case for it coming back. And that really is a key theme in Candriam's investment process, which is really rooted in identifying winners and losers. In today's complex situation, our portfolios are tilted towards defensive sectors that offer resilience. So specifically, we favor telecommunications, we favor media, we favor TMTs, really, healthcare, and to a certain extent, utilities. And these sectors really, they benefit from business models that are less exposed to cyclical demand and geopolitical turmoil, and to a certain extent, tariff disruption. So since they're relatively immune from that, they do resist these markets better. On the other hand, we are cautious towards more cyclical segments like autos and consumer discretionary and the retail segment, which have more. I'm sorry, I'm not sure I'm still on air, but I will continue anyway. Which are much more vulnerable.
No problem. Okay.
Which are much more vulnerable to weaker consumption and external shocks. So again, defensive sectors versus cyclical sectors. We favor defensive, cautious towards cyclicals. On an issuer level, we have a strong preference for companies with very solid balance sheets, stable and visible cash flow generation, and a commitment to deleveraging. And we believe that this is very essential in the current credit cycle, the late stages of this expansionary cycle. We believe it's important to have companies like that, companies that are large corporates with diversified revenue streams and the ability to pass on inflationary pressures, to pass on these costs, right? So that they are better positioned to preserve margins in a very challenging environment. In the high yield space, our preference is towards more domestically oriented issuers rather than exporters who remain at the mercy of shifting trade dynamics and tariff regimes. So really, in short, in this phase of the credit cycle, we really want to be much more selective. We want to favor defensive segments. We want to be cautious towards cyclicals, and we want to favor sturdy, stable, cash-generating businesses that are in deleveraging phases.
CHARUDATA Shende, Head of Client Portfolio Management Fixed Income at Candriam. Thank you for your time, for your patience, for sharing us your strategy at Candriam, and thank you for coming in Negocios TV.
Thank you very much. It was a pleasure. I hope to be back again.